class we studied about mutual fund. A mutual fund is a trust that pools the savings of a number of investors who share a common financial goal. Okay. Then it is a trust that pools the savings of a number of investors. Okay. Then the money thus collected is invested in capital market instruments such as shares, debentures and other securities. Then the money collected, they will invest in shares, debentures and other securities. Anybody with an investable surplus of a little has a few thousand rupees can invest in mutual funds. Then in mutual fund we can invest little amount like 1000 rupees also we can invest in mutual fund. It gives the market returns, not assured returns. What is the problem? It gives the market return, not the assured returns. Means we cannot guarantee like you will get 500 rupees as return. Like that we cannot guarantee, but we will get returns. That is the rule in market. Okay. Then the mutual fund industry in India started in 1963 with the formation of Unit Trust of India at the initiative of the Government of India and Reserve Bank. In 1963 it started with the help of Reserve Bank of India and Government of India. The history of Indian mutual fund can be divided into 4 phases. Okay, first phase from 1964 to 87, Unit Trust of India established in 1963 by the Act. At the end 1988, UTI had 6,700 crores. Then next phase was like from second phase, marketed entry, non-UTI public sector mutual fund set up by public sector bank, Life Insurance Corporation, General Insurance Corporation of India. Then after that 1987, SBI mutual fund was the first non-UTI mutual fund, and third phase 1993 was the year which the first mutual fund regulation came into being, under which all mutual funds except UTI were be registered and governed. Okay, then first private sector mutual fund registered in July 1993. As at the end of January 2003, there were 33 mutual funds in total assets of near to 1 crore. Okay. Then in February 2003, following repeal of Unit Trust of India, UTI mutual fund sponsored by SBI, PNB, BOB, Bank of Baroda and LIC registered under the SEBI, function under the SEBI Mutual Fund Act. Okay. Then here you can see investor, you can see securities based on common financial pools of money, fund house, fund managers generate and pass back to investor. Return whatever is there, that one will give to investor. Then types of mutual fund, by maturity period we can classify into open-ended and closed-ended scheme. Okay. By investment objective we can classify into growth fund, balance fund, gilt fund and money market and index fund. These are the classification of mutual fund. By maturity we can classify into open-ended and closed-ended scheme. Okay. Then we understood that this some principles are there for mutual funds. Some principles are there. Especially this principle is we need to learn this principle before investing in mutual funds. First principle is learn before you begin. Before you begin, you should learn how it will work, what will be the goals. You will need to learn the basic things. It is very important to understand investment philosophy. Okay, then next one, regular and disciplined approach. That one is important factor for investing in mutual funds. This will go a long way in achieving your long-term investment objectives. Regular investment in mutual funds provide an easy way to grow your investment over time. Okay, then spread your objective over various mutual funds, and various type of scheme are offered. By spreading your investment over different types of funds, you increase the chance of averaging better returns. Okay, by spreading your investment, another one objective is spread your objectives. By spreading your investment over different types of fund, you increase the chances of averaging a better return. Means we need to invest in different type of funds. Think long term. Okay, that one is the another principle. Give your investment time. Do not expect short term gains from mutual funds. Also, do not expect super performance from your fund every year. Okay, then you need to think long term. That is the another specialty. Then before that we need to study about what are the basic schemes and what are the basic structure of the mutual funds. Here you can see the open-ended scheme. In open-ended scheme, structure of mutual fund is that allow investors to buy shares from mutual fund at its unlimited level and time and sell it when they want in market. Okay, then in open-ended scheme, mutual fund which allow investors to buy the shares from mutual fund at its unlimited level and time. Okay, whenever you want you can sell it. Okay, that one is the open-ended scheme. Then closed-ended scheme. Closed-ended scheme issues mutual funds under many restrictions, like to offer limited investors or limited time of issue. Okay, then closed-ended scheme, time limit will be there or restrictions will be there. That one is the closed-ended scheme. Then another one scheme is interval scheme. This is a mutual fund scheme whose redemption features is between those closed-end and open-end funds. Okay, means redemption features is between closed-end and open-end funds. Okay, this is of investment objective. We can classify as growth schemes. What is growth scheme? In the growth scheme, all profit is made by the fund are plowed back into the scheme. This causes net asset value to rise over time. The net asset value, it is a price of value is the price of a unit of a mutual fund. Means the performance of a particular scheme mutual fund is denoted by the net asset value. Mutual fund invest in the money collected from the investors in securities market, and net asset value is the market value of the securities held by the scheme. Okay, then if you are taking an example, if the market value of security of a mutual fund scheme is rupees 200 lakhs and the mutual fund has issued 10 lakhs of rupees 10 each to the investors, then net asset value fund is rupees 20. Okay, that one is net asset value. Okay, then growth scheme. First one is growth scheme. Then another scheme is income or dividend scheme. In that scheme, the dividend options does not reinvest the profit made by the fund through investment. Income or dividend scheme. In that scheme, the dividend option does not reinvest the profits made by the fund through its investment. Instead, it is given to the investors from time to time. Okay, it will give to investors in time to time. Another scheme, balance scheme. The aim of balance scheme is to provide both growth and regular income. Such scheme invests both equities and fixed income securities in the proportion indicated. Generally invests 40 to 60% equity and the rest in the debt instrument. Then other mutual fund schemes, money market scheme. It is open-ended mutual fund whose amount will be only invested in money market. These funds invest in short term. Then the main goal is to preservation of principal. Then another scheme, tax saving scheme. For getting tax benefit under this scheme means any exclusive of tax advantages, like mutual fund company will give tax exemption. For that one, some tax saving schemes are there. That one is another scheme. Then another special schemes will be there, like mutual funds provider will mention this in invitation form, and special schemes will be there. Index scheme will be there. Index scheme means attempt to replicate performance of a particular index such as BSE, okay, Bombay Stock Exchange. Then what is the reason to invest in mutual fund? When you invest in a mutual fund, you buy into experience and skills of a fund manager and an army of a professional analyst. Then another thing, limited risk. Mutual funds are diversification in action and hence do not relay the performance of single entity. Then risk will be less. Okay. Then another thing, more for less. For the price of one blue chip stock for instance, you could get yourself units across the number of companies. Then another thing, convenience. You can invest directly with a fund house or through a bank or financial advisor. That one is another convenience. Then investor protection. A mutual fund in India registered with SEBI and also monitors operation fund to protect your interest. Then quick access to your money. It is good to know that you should need your money at short notice. You can usually get in 4 working days. That is the another feature. Then transparency. We know in mutual fund, as an investor, you get updates on the value of your units. You can see in news, and you will get like these news in online also. Information on specific investment made by mutual fund and the fund manager's strategy and outlook. Then another feature is low transaction cost. A mutual fund, by sheer scale of its investment, is able to carry out cost-effective brokerage transaction. Then another feature is low transaction cost. Then transaction cost is or brokerage cost is very less and it is cost effective. Another benefit, over the years tax policies on mutual fund have been favorable to investors, continue to be so, means tax exemption will get. That one is the another feature. Then advantages of mutual fund: professional management, minimization of risk, return of potential, low cost liquidity, and choice of schemes, tax benefit. These are the advantages of mutual fund: professional management, minimization of risk, return potential, and low cost liquidity. These are the advantages of mutual funds. Then what are the disadvantages? Cost control not in the hands of investor. Then no customized portfolios. Then another thing, difficulty in selecting suitable fund schemes.